Hey, what's happening, everybody? I hope you're doing well. There has been an absolute ton of talk about this topic right here, and it has to do with some articles that came out a few weeks ago talking about Biden making some changes and essentially punishing people with good credit and rewarding people with bad credit. So what I wanted to do is record a quick video, explain it all to you, kind of show you where they're true, where the truth is in that story, and then also dispel some myths that are part of that story as well. So let's take a deep dive into it. The first thing that I'll show you real quick, look at what we got here. We got just a couple samplings of the articles that we're seeing. We're seeing good credit home buyers to subsidize risky loans. We've got Biden set to increase payments for home buyers with good credit and subsidize the risky mortgages. And again, there's a little bit of truth to it. We'll kind of explain exactly what that is and why you have to know a little bit more of the entire story, not just this little snippet. What they're reporting on, which sounds fun and gets you to share the articles and watch the TikTok videos, is a little portion of the bigger picture here. So let's jump in and explain exactly what's going on. So this table that you're looking at is a table called an LLPA. So LLPA is short for loan level price adjusters. I'm only going to show you the purchase money loan LLPAs, but these are accurate. What the table that you're seeing right here is accurate as of May 1st. There's also a table for refinances, both cash out and rate and term. And then you'll notice at the bottom here, there's additional LLPAs that are applied regardless of credit score, just based on the scenario, what kind of home you're purchasing or what have you. So essentially, if you look at this chart, and over here on the left side is all the credit scores. And then over on the right side, these are loan to values. This is after your down payment. This is the remaining loan versus the value of the home. And so you have somebody here with maybe a 5% down payment and a 780 plus credit score. They have an adjustment of 0.125. Now it's not 0.125 in rate. It's 0.125 in fee. And so as an originator, what we do is we'll generally add either a point, that 0.125 is a fee on the loan for the same interest rate. Let's say the interest rate was 6% and there were no adjustments made yet. Then you would have that 0.125 adjustment. That would be a fee you'd have to bring in for closing. Or you could sometimes take the next tier up, in this scenario, maybe 6.125, and it would give you a rebate back. And that rebate could be used to offset some of these adjustments here. And in most cases, if you move the interest rate maybe a quarter, 3/8, or maybe even 0.5%, a lot of times you find that maybe you get a whole point in rebate that can absorb some of this. So the change to the rate isn't really that significant, but it's paying a lot of these extra costs. And so when we're pricing those loans, we're already kind of factoring a lot of that stuff in. That's one reason why if you have really solid credit and you get a rate quote, you're going to get this really low interest rate. And if your credit's a little marginal, you're probably going to get a higher interest rate because the lender is looking to take these additional fees. Like in this case, a 639 credit score with 5% down has 1.75 in point adjustment. And so again, that borrower who has a 639 with 5% down, they've had some credit struggles in the past, and there may be a good chance that they don't have a lot of cash behind them. So instead of having to pay that extra fee of 1.75, maybe they're going to build that into the loan, and that lender may offer them a 7% interest rate to absorb all those costs. Okay, so that's kind of how that works. And so what you'll do on this chart is you can see if you're putting a lot of money down, you're putting 70% down, none of them, not even the low credit score, has any adjustments at all. You get the best rates, you're good to go. But the minute that you put less than that down, this 639 bucket starts to have some adjustments, and they start to really increase as you put less and less money down. And so this group right here, this is the one that's kind of on the hot seat because they're saying, hey, they're getting these great deals, these great benefits. They're still paying more in the way of fees than somebody who has a higher credit score. So again, in this scenario, 5% down, 780 credit score, only an 1/8 adjustment in their pricing versus somebody who has a 639 credit score, they have 1.75% in adjustments. So they're going to get a higher rate or they're going to have more fees. That didn't change. But what did change is prior to this move here on May 1st, that 639 credit score was actually about 3.5 points. It was much, much more expensive in that place. So they reduced down how much that is. But they also made some changes over here to people that had 720, 740 credit scores, 20% down, 15% down. They're actually going to pay a little bit more. These adjustments that you can see right here are in real time. These are after all the changes on May 1st. I have a heat map on the next slide that I'll show you that shows you where all the impact was made. It's important to kind of recognize also in the LLPAs, all the other places where we adjust. So if you have an adjustable rate mortgage, there's adjustments across the board. If you have a condo, if it's investment property or second home, manufactured homes, 2 units to 4 units, you can see the list right here. If your debt ratio is over 40%, or you have a subordinate financing, meaning you maybe have a second mortgage that's going along with this, there are adjustments that are being made across the board here. So these adjustments stack based, let's say at a condo, debt ratio was over 40%. You had a equity line of credit, maybe a secondary financing that was also being applied, and you were doing, let's say 10% down, you'd have 0.375, 1 1/8, and you'd have this 0.75. And then depending on where your credit score is, you'd add all that to that. You're probably going to have some points in your loan. It's not going to pencil out real well. Even if we move up in the rate quite a bit, it's going to be pretty expensive. So that's one area that we as a lender are kind of always looking at. How do we shift you into maybe better buckets here? Maybe we need to move you up on the credit score a little bit. Maybe there's a small change we can make that will lower your overall cost, or maybe if we put a little bit less money down, in some cases we'll get a better deal, because you'll notice even at a 780 credit score, which is a fantastic credit score, you have an 8th adjustment here with 5% down. But look over here. If you put 20% down, you're paying 0.375. You're actually paying more if you're putting 20% down. And it's true for all the FICO ranges. It's just the more money that you put down, the more of an exposure it is to the bank. Meaning that if you put 20% down, you've got 20% of your money into the game. And if you foreclose on that, the bank is leveraged to 80% of the value of the house. But if you put 5% down, you have 5% of your own money, but you need mortgage insurance. Mortgage insurance is going to provide security to the bank, sometimes 15% all the way up to 30% coverage on the mortgage. And so you take your 5% plus, let's say 20% that they're getting in mortgage insurance and layer that together. And now the bank isn't exposed as much to that loan. If it was to go into default, they actually look better. It's almost the same as if you were bringing in 25% in that scenario. So that's why the pricing's better with these low down payment options, because the more expensive mortgage insurance is actually lowering the exposure for the bank. Even though they're lending out the money, if something goes sideways, they have that extra insurance that's going to offset their cost, right? So that's the reason why they're promoting a lower down payment option. Here is the heat map. This is the map that's showing you all the changes. So anything in green got better, anything in yellow got a little better, anything in orange and red got a little bit more expensive, and then this kind of neutral color, this tan, didn't really have any changes. So you can see even the 780 credit score, it improved 0.625. It's better in price than it used to be. They lowered the lower credit scores got the biggest lift. You can see here 1.75. Remember, it was 3.5 points at one point. Basically said, hey, we don't want those loans. We're going to charge a ton of money for them. Not a lot of borrowers went that way. We usually took those borrowers to FHA or other financing because it was cheaper. It was a better deal for them. But now Fannie Mae wants to kind of entertain some of those again. So they lowered down those costs. That's the area where the article's saying, hey, they're getting a break. They're getting a good deal. They're still paying more than everybody else. They're just not paying as much as they were going back a few months. But the biggest hit is right here. And this would be considered your good credit score borrowers, somewhere from 680 all the way up to 780 for that matter, got worse. You can see it's almost like a big cross right here. So as you're putting like 10%, 15, 20, 25% down, these adjustments are actually going to cost those borrowers a little bit more money now. Why? That's just, there's data that Fannie Mae and Freddie Mac are looking at behind the scene saying, this is a more risky environment for us. We need to make some adjustments moving forward. This is what we're going to do. So this is the crux of where those articles are coming from. They saw these big adjustments right here saying, hey, they're robbing from the rich, the good credit score, rich folks, right? And they're giving to the poor, the folks that have the bad credit score. That's all that the article is really based around. But the truth is that everybody that put less money down actually got a lift. As you put more money down, you're actually being penalized. So it should have actually gone the other way and said, hey, people that put less money down have a better deal than somebody who's putting more money down. That's kind of how these new adjustments came to fold. I wanted to point out a couple of ways to win with this. So if you're a first-time home buyer and you fit some of these programs, Home Ready being one of them from Fannie Mae, there's a few others that are out there. This is an area where all those LLPAs, they're completely waived. There's nothing that you have to really worry about on that. All the adjustments that we saw a couple of slides ago completely go away, regardless of your credit score. They do not have the adjustments on the home ready loan. So it's one place as a first-time buyer that we're going to look immediately to see if you fit that, because you're going to get better terms that way. It's almost like if you were putting 3 to 5% down, but you're getting the same interest rate as somebody who's putting 40% down who's not a first-time home buyer. So first-time home buyers still looking pretty good on these programs. A couple of other ones that work out real well. Manufactured homes with the MH Advantage works good. Some of the rural housing. There are some Native American loans that we need to look at. So there's a few things in here that we always are looking at on the application just to see, can we put you into that bucket? Because if we can, we're going to avoid all those extra LLPAs. It's going to make things a little easier moving forward for you. The biggest question that we get all the time now is, how does this impact the housing market? And so as we kind of look at some bullet points here that I wrote out, I think you got more people that are normally going to go to FHA financing that are now going to be able to maybe fit the conventional financing bucket just because of the relief that we're seeing from the fee standpoint. Maybe FHA doesn't have that drastic better. If you were to compare them, it's drastically better. Typically FHA with lower credit score than conventional, they're going to kind of shore that up a little bit. So now it's maybe a little bit more competitive. And that's good, because a lot of times there's properties that maybe they just aren't going to pass FHA, and or the sellers for some reason or another saying, hey, we can't do FHA, or it's a condo complex that, that it's not FHA approved, but conventional is okay with it. Well, then we can take those people conventional now, because they don't have those extreme adjustments that are made on their loan. They're still going to pay a little bit more, but maybe not so much. Lower credit score borrowers are going to have improved rates in closing. So we know that that's going to help promote homeownership. The mid-tier have to be very, very careful with how they position their down payment. And this is something we talk about a lot. Do you really want to put 15, 20% down? I know you want to get rid of mortgage insurance, but there's a cost. And so we want to recognize what that cost actually is. Maybe it actually is better to put 5% down or 10% down on that purchase, leverage the mortgage, take all that extra cash. Maybe you're applying some other debts off. You're going to pay off the car or credit card or student loan or something like that. You kind of look at the total debt that you have outgoing. And if it's less, it would make sense to consider that. So just another thing that we need to be aware of. Again, just be prepared. If you're going to put 20% down to get rid of the mortgage insurance, may actually cost us a little bit more. There's also some tricks you can do. Sometimes you can take and put slightly less down that would require mortgage insurance, and it would reduce the LLPA, except you can do a one-time fee to buy out the mortgage insurance. So a little bit of a game. Maybe that one-time fee to buy out the mortgage insurance is less than that new hit for that bigger down payment. So some things that we'll start to look at there and see if we can help give you a little bit of guidance. Again, you got to kind of know the chart, up or down in the chart, based on credit score, side to side, depending on your down payment requirements, really going to change how much you're going to pay in the way of fees, in the way of points, in the way of getting a better interest rate. So we want to watch that on our side when we try to advise you. All right, guys, any questions that you have, let me know. Just feel free to reach out. There's a link to my calendar and application right there in the QR code. We're looking forward to talking to you guys very, very soon. All right, take care.